And we are live. Welcome to this edition to Tax Tips Tuesday. I love Tax Tips Tuesday because, I love making money, but I don't necessarily get really excited about writing huge checks to Uncle Sam. I don't know about any of you, but I think that if we are here to build a fortune, only to write a big fortune check to Uncle Sam, that's not really wealth. And I really believe that we can leverage the tax code in our favor, but we have to know the rules of the game. Most people are playing money checkers, is what I call it. They make some money and they pay some money. They make some money and they pay some money. That's like a one and one, right? That's like really boring. Well, if we're playing money chess, then we can see the moves down the road. We see that tax bill coming down the road, and we can strategically plan for that and learn how to mitigate it, eliminate it, and reduce those taxes, unnecessary taxes. And my guest, she's incredible. She comes to us with over 2 decades in the accounting and tax business. And she says the tax code is a treasure chest when we understand how to leverage it in our favor. We just have to find those treasures that are hidden there. And today we're going to talk about cost segregation for real estate and real estate investors. So if you're a real estate investor and you're looking at advanced strategies, or you want to be in the real estate investing area and you're thinking about getting your real estate license, or you're just getting started, this is one for you. And if you know somebody who's in real estate, tag them, invite them in. We'd love for you to come in, ask your questions. And today, like I said, we're going to talk about cost segregation for real estate investors. So take it away, Miss Chris.
Okay, y'all, we're back. So I do not usually make blanket statements, but I'm willing to make a blanket statement and say that everyone who is interested in saving on taxes should give serious thought to real estate. And a lot of people ask me, well, everyone is talking about real estate. Every time you talk about tax planning. Why is that? I don't understand. There have to be other things. And yes, there are other things. But it is very rarely that you will find an asset where you can leverage a small amount of cash to give you an asset that is so much bigger in value than the cash that you're spending. Then you can cash flow that asset and get paper losses that can put real money back in your pocket to help you to buy another asset and give you the tax benefits, right? So, blanket statement. If you're serious about saving on taxes, you need to be serious about investing in real estate as well. It doesn't have to be the only avenue, but it needs to be an avenue. So cost segregation, we hear it everywhere. Everyone is talking about cost segregation. So what is cost segregation? So it's basically accelerating depreciation on a property. So what that means is when we purchase a property, it could be a residential property or a commercial property. Depreciation is spread over a long amount of time, right? So it's 20, I think it's 27 and a half, and maybe 32 years, something like that. I may not have the numbers exactly right, but it's in that wheelhouse. So no, it means that even if you purchase an asset that is $1 million, you only get to depreciate it over that time, which means you get in a small amount of depreciation, and your real estate income is usually passive. And so when you have losses, those losses are stuck in this basket because you can only use them against other passive income. So passive losses can only be used against passive income. So if you have a property that is a rental property, there's a couple ways that you can leverage that property for tax benefits. There's short-term rental loophole, which is different from cost segregation, and then there is cost segregation. So cost segregation allows you to accelerate the depreciation. What that means is I get to take more depreciation now rather than take small amounts of depreciation over time. What that does is it allows you to create bigger losses that you can take against ordinary income. But cost segregation is not for everyone because there's certain criteria that you have to meet before you can cost segregate a property. And the number one thing is you have to qualify for real estate professional status. And when someone hears real estate professional status, they think, well, real estate agent. It is not the same. It is two different things, right? So if you qualify for real estate professional status, it means that real estate is either your main activity. This is what you spend more time in during the year. You're materially participating in it, or there is no one you spend at least 100 hours working on that property and no one else has more time than you, or 750 hours working in real estate activities. So now, if you qualify, no, that changes everything because that means now when I cost segregate, which means that I can take that asset, and a cost segregation is basically a study. Someone does a cost segregation professional does an analysis where they will break down the asset into different asset classes. So instead of one class depreciated over 27 and a half years, it is now broken down into different classes where it is 7 years, 5 years, 15 years. And so now you can accelerate depreciation. Accelerating depreciation gives you more deductions. Now, so let's say, for example, I had a client who just had a cost segregation study done on a property that was placed in service in 2023. So the property was placed in service in 2023, but she did not perform a cost segregation study. So we did that in 2024. Now, 2023 bonus depreciation was 80%. So she could cost segregate the property, accelerate the depreciation, and take 80% of the cost of that depreciation in 2023, and then the 60% in 2024 because bonus depreciation was in 2024. So she ended up with $142,000 as depreciation to help reduce her tax bill for the year. And there are clients, depending on where your property is located, there are clients who purchase $1 million properties in A markets, and a cost segregation study will yield maybe almost $1 million, sometimes more. It just depends, right? And when that happens, you get to use that depreciation to wipe out your ordinary income as long as you qualify for the real estate professional status. So in a nutshell, that's cost segregation. It is basically breaking down the assets into components that I can now take the depreciation earlier rather than later, and the depreciation now qualifies to be taken against my ordinary income instead of being locked for passive income until the sale of the asset. And that's it in a nutshell.
I know that she's so funny. That's it. Okay, so let's kind of unpack this a little bit if we could.
Mhm.
So to qualify to be a real estate professional, you don't have to be licensed. How do you show that you're actively in the working on the property? Does that mean that you're fixing things? What does that look like?
So to qualify for real estate professional, it is difficult to qualify for real estate professional if you only own one rental property, right? How are you going to justify, well, how many hours that you spent on it? But there is also the 100 hours, and no one else has the same amount, has more hours than I did in that activity, right? So there's different ways to qualify. And so the activities that qualify, it's not just working on the property, as in I'm fixing things and the handyman or whatever. It is me doing the administrative work of taking care of the property. So if I own properties, say I own $5 and I'm the one who's administering rent, I'm collecting rent. I'm the one who I'm calling the plumber when something is broken. I'm calling the electrician. At any work that you're doing on that property, that isn't connected to that property qualifies as working on the property or working in the property.
Okay, that's good. That helps. So now let's kind of talk about, you said that particular client got what, 142,000?
A year, 142.
142 for that year. What would have been if they hadn't done the cost segregation? What would have been their tax benefit for that year?
6,800. a little over 6,800 in depreciation.
About almost 7,000 compared to 142,000. 6,000, 142,000. Which one do you like better? So why wouldn't somebody do this? I mean, that's dramatic. That's not like a little bit, that's dramatic. That really changes. And then that's a lot of money you could put back into your own pocket and start investing into your future. So
Mhm.
why would someone not do this? Because I talk to a lot of real estate investors who they feel like they've done this, but I know they haven't done it to this extent, or they just don't even know about it.
Well, because a lot of people, a lot of strategies that we hear about, a lot of it comes from just social media, people who are just talking about things most of the time that they have no idea what it is they're talking about. And so there's so much information, so much confusing information out there. People get overwhelmed with the information and then do not know what to do. When you overwhelmed, you get analysis paralysis, and so you don't take action. Or you hear someone say, well, I got I saved $700,000 in taxes just from using cost segregation. You're like, that's not possible. That's not true. They're telling lies, right? And so you don't believe it, and so you don't try it. It is information, is being able to having access to credible information, getting information from people who are actually helping clients to use those strategies, people who are knowledgeable about those strategies, so that you can trust the information that you get in, rather than I just heard it, or someone said something and now I don't trust it, and so I don't do it, and I lose out on it.
That's really a great point. So let's talk about if somebody is thinking about doing this, what are some questions they need to ask themselves to see if this could be a good fit for them and take the next step?
Well, the first thing is, do you qualify? Because not every strategy is for everyone, and there are people who may own real estate and they don't. The real estate is managed by other people. So there's a management company managing your real estate. There's someone, so it everything to do with that property is managed by someone else. You don't qualify because you don't have the material participation. You don't meet the criteria to qualify to use a strategy. So the first question is, do I qualify? And so when you ask yourself, do I qualify? It means that now you need to find someone who actually know the rules, right? Because I may hear that I qualify, or I may think that I qualify, but I do not know the nuances of the qualification. So now I need to find out. So the first thing to do is have a conversation. I always say that it doesn't hurt anything. It's never hurt anyone to have a conversation about something that could help change your life, right? You have the conversation. It may benefit you, or it may not, but you will leave that conversation knowing something that you didn't know before. So have a conversation.
Yeah, that's great. And then that particular tax professional, hopefully it's you, it should be you, would have the resources for cost segregation study. Does that something that is free? Do they like, how does that, what is the
So
cost involved?
there's different ways to get a cost segregation study. You can have someone do a physical study of the building. That one is a little bit more costly, or you can use an online platform where you provide all the documents related to the building. So the purchase documents, anything that will tell them what the value, the size, whatever of the property, and they will do a cost segregation analysis for you and present it to the IRS. And then you not present it to the IRS, but this is what you use to get the benefit, and that's the study that you would use. So say for example the IRS is querying the your method, then okay, this is a cost segregation study that I use, and this is why I'm able to take the amount of depreciation that I took. And so there's the two routes to go about it. I always believe that you should work with someone, a tax professional, who can connect you with the cost segregation professional, rather than you going online and trying to find one of your own, because that person would have already vetted people in their network, so that they can connect you with someone that is trustworthy, someone that is a real professional who knows what they're doing and that you can trust.
Yeah, that's absolutely true. And that's where the family office concept comes in, right? Is really having that professional. You need that tax professional that is really suited in your area. Not like H&R Block, right? We're talking about a CPA, enrolled agent, those designations that can really guide you and take you through if there should be an audit process. Number two is you need an estate planning attorney, somebody that know that is, don't do this online either, you guys, right? Somebody who can really help you set up that estate, and which would be an attorney. A tax attorney is always important to have a relationship with a tax attorney. And then, of course, I believe you should have a licensed life and health insurance agent, because we can do things on the back end that your wealth management, your financial advisor just cannot do. They're not licensed. They don't have the training and certification to be able to do that. So this was incredible. I love this topic. I think it is a real secret for anyone who is in that real estate investment area, or they're thinking about getting into real estate. I mean, take advantage of all the tax advantages there are available to us. And that's really how we can build what I love to talk about, the family dynasty. You know, it's one thing to build wealth, it's another thing to build that wealth, keep your wealth, and pour it into future generations. Because when we teach you how to save that money, we're also, by the way, going to teach you how to properly invest that money. You were going to write a check anyway. So now let's go ahead and start building your family dynasty and changing your family's last name forever. You know, we've already had financial poverty. We've already had that. Let's break those generational curses and create the cycle of prosperity, because the majority of wealth only lasts for one generation. I don't think it should be that way. I
Um,
believe that every generation should build up the next. Go ahead.
I think that this is what puts us, I think, in a different league than most other people in the financial space. There's so many people in this space where they focus on one area, and I think that it is impossible to provide someone with the optimal result by focusing on one area. So I believe that every person, every business person, every person who has the desire to create wealth, and you're in that space where you have income that where you pay too much taxes, you need someone in your corner who looks at more than your taxes. You need someone who looks at, yes, your taxes. How are the tax savings going to work for you? Investments. How are those investments working for you? That everything is working together. Your estate planning, your insurance planning, like you said, everything is working together cohesively, so that at the end of the day, it is not one hand is doing something over there and the other one is doing something, and neither one knows what is happening. And when that happens, you can't benefit from that, because you're going to get a tax benefit there, but your investment advisor is going to take it away from you there, because his focus is getting is growth, not tax mitigation. But if your investment advisor and your tax advisor are working together, now we have tax mitigation and growth together, intertwined.
Yeah.
And now that's the optimal result, right? And that's what I want for everyone that I work with. That's how I work with my clients. It's not just me on this side, it is a team, it is a network. So that at the end, when you come to me this year, next year, by the time next year, there's going to be a transformation in your finances.
Absolutely. If you can do patty cake with them, then you know they're working together. And I call it holistic and proactive planning. Otherwise, if your advisor, whatever that advisor is, your tax advisor, your insurance advisor, your wealth management, if they're just a product peddler and they only sell one product, they say they want to stay in their silo. I think that is so last year. That is so a decade ago. Now it's about holistic and proactive planning, where your specialists are working together to create a beautiful symphony. Because remember, if one note is out of tune, it ruins the entire concert. So that's what we're going to share. Thank you so much for joining us. If you're watching this on Team Replay, put hashtag Team Replay and share this with people that you know who would enjoy learning about this treasure chest we call the tax code. And we're here every other Tuesday, so we won't be here next week, but we'll be here the following Tuesday. And we're always ready and willing to take your questions live. So thank you so much, everyone. We appreciate you. And we'll see you on our next Tax Tip Tuesday. Remember, this is your year to rise up and thrive in 2025 and make it the best year of your life.